let me now proceed to the next panel, which actually is going to be a roundtable discussion panel. This panel is going to be moderated by Elizabeth Meager. Lizzie, thank you very much for being with us today. Elizabeth is acting deputy editor at the Sustainable Views at the Financial Times. So she's an expert in this ESG field. So Lizzie, thank you very much for being with us today, and the floor is yours for your panel.
Great, thank you so much. Great. Well, thank you very much for having me. So, as Professor Skiadopoulos said there, I am acting deputy editor of Sustainable Views from the Financial Times. I actually cover the US, where ESG has become particularly polarized. So this is a great panel. I'd like to briefly hand over to my panel to introduce themselves. So if everyone could unmute and show yourselves, that would be great. Great. Sean, would you like to go first?
Sure. I'm Sean Kidney, CEO of the Climate Bonds Initiative, green bonds, social bonds, sustainable bonds, hitting $6 trillion outstanding this week, by the way, and continue to grow despite the kerfuffle. In the first quarter of the year, US green bonds were down by 25%, only by 25%. Taxonomy, regulation, all those sort of things all around the world is what I work on.
Great. Okay. And Dimitrios?
Good afternoon. Thank you, Elizabeth. My name is Dimitrios Dimopoulos. I'm the head of ESG at Piraeus, working for the bank for the last 20 years and promoting sustainability issues around climate, around energy, around sustaining our reducing our environmental footprint, reporting, CSRD, and of course, touching upon issues that have to do with nature, biodiversity, and other social issues such as environmental education, training within the bank. And I'm really, really happy to be with you here this afternoon.
Great. Great, likewise. And Maya?
Yeah, hi, thank you very much for having me. It's a pleasure to be here again. EBRD has been supporting this for the past year, so we're very happy to join. My name is Maya Hennerkes. I'm Director for Green Financial Systems at the EBRD. We are investing in almost 40 emerging markets from Morocco to Mongolia and have a quite high target for our own financing to be at the minimum 50% green. So we work very closely with our corporate clients, with financial institution clients, also municipalities and some sovereign clients to really green themselves, to green their businesses, to decarbonize. And yeah, I'm very looking forward to this conversation, and also really happy to be here with very good friends, Sean and Dimitrios.
Great, glad to hear it. Good, okay, so we have so much that we could talk about. So to kick things off, so what we try to do in our coverage at Sustainable Views is not just report that so-and-so has left whatever climate coalition, or Donald Trump is talking negatively about sustainable investing, but to actually kind of go beyond the headlines and think about what businesses are actually doing and whether the focus really has shifted in reality. So my first question, which I'd like to kind of open to the floor really, if anyone has a thought, is like how real this kind of ESG at a crossroads concept really is. Are we really at a crossroads, at a crucial turning point, or is this just kind of being overblown by some in the press?
Hey, I'll get going.
Yeah.
And I just want to say, it's been many years since I've seen Dimitrios, so thank you for getting us together again, because the last time
nice to see you again, Sean. It's been a long time, really.
It has.
And Maya, we haven't met for a long time too, so it's really nice to see you again on this panel.
And I suppose that's a segue into the point that there's a whole bunch of people working on the things that we need to do to create a better world while doing well financially. That have been beavering away and talking about this, like Dimitrios, like Maya, for many, many years. Hey, that's not changing. That's not changing in the US either. Last week I had a drink of a friend of mine who's the sustainable investment manager for one of the largest asset owners in the US, who says they've taken everything off their website around DEI. They have stopped making all speeches. They've gone quiet. They have not changed a single investment methodology. And in fact, even Larry Fink, when he was famously said they're no longer an ESG house, he was also at pains to say is they're not changing their investment methodologies. If we are genuinely looking at data points, at methodologies that achieve material better returns over a longer period, it's an issue of horizons as much as anything. This is not for day traders and the like. Then realistically, we're not going to abandon data points or ways to look at things which get better returns. But if we've been including criteria that we don't actually think there's a solid evidence for, feel good or sales stuff, yeah, maybe it's time to start letting some of those things go. Of course, one thing that is being let go is if you're an asset manager and you don't actually take these things seriously. And I can remember sitting in a circle of asset owners in Boston years ago saying, how do you tell if an asset manager understands ESG? You ask them if their CEO's portfolio has got ESG filters over it. And if you're one of those that you don't have an ESG portfolio, well, you're probably going to drop this business. You know what? Maybe that's a necessary shakeout here. But the data about performance of sustainable investments, especially green investments, is very clear now. That's not going to change. Institutional investors are not going to change their perspectives as a result.
If I may add to what Sean just said, that we're looking. What we can see is that the cause of sustainability and ESG is still there. That's climate change. It's the degradation of the environment. It's all the social issues that follow from all these environmental issues. So either we like it or not, these problems will remain. So I think that companies, big companies, smaller companies, will still like to see what's happening with their risk, environmental and social risk. So what I feel is that what we're going through now is just a period of maturity. We have reached a point where, some years ago, there was a bit of an ambition in how we set targets, and now it's time to deliver. So I think it coincides with a time of maturing, understanding the impacts of the decisions that were made a few years ago. The world is not the same. When we started talking about targets like this, we didn't expect that we're going to have 2 years of COVID, that, the economy will actually lock down. We didn't expect, or we didn't know that we're going to have all these wars in the backyard of Europe and other places, and all the other issues, the political issues that, we're facing today. So I think it's a time for maturing, looking, being flexible, and staying the course.
Maybe I will share first a very personal observation and then something a bit more scientific. So the more personal observation is, I think if you've been working on ESG and sustainability matters for quite a long time, like I guess the three of us who are here in this conversation undoubtedly have, we've all seen waves already. It's not a surprise. It comes and goes. I remember there were times where, as the E&S officer, I was the least popular person on a deal team, even after the lawyer and the risk officer. So this does not faze us, I don't think. I also fully agree with what Dimitrios said about the maturing state. I think a lot of the low-hanging fruit, we've harnessed them. And now we have to tackle the really difficult stuff, the decarbonizing of really hard-to-abate sectors and convincing the really tough clients that have resisted for a while. So that obviously, it's a bit of a curve where it gets harder, and it doesn't mean that it's not happening. Maybe, but more scientifically, we've actually asked our financial institutions clients that exact question last October. Granted, it was just before we've seen all the news stories of US banks exiting, climate commitments, and so on and so forth. But maybe just to share a few numbers that I thought were quite interesting. We've asked 100 of our partner financial institutions across 32 economies in our region, and awareness is not an issue anymore. We've seen that 99% of them, they know that climate is super important. They get it. They have awareness. When we had asked this question again in 2021, the main reason they said that they're struggling with is the regulatory environment. Now they're saying that's sort of much more clear now. It's more the data availability that they're struggling with. Now, what we've also seen is that boards, sort of top level company involvement has increased a lot. So from our clients that we've surveyed, almost 60% say that their board now has a formal responsibility for climate matters. So I think we see there that this is quite, it's there. There's no dampening of the enthusiasm of at least the banks that we've spoken to on those matters. It's also, a lot of them said that they see this really increasing over the next 3 to 5 years, both in terms of targets, but also in terms of business opportunities for them. So a lot of them already have green products. Some of them, almost all of them have already green products. Some have a very simple green product, like a standard, maybe lending, green lending for, I don't know, some renewable energy technologies or energy efficiency. But they all say, oh, we're working on more because we think that this is really going to increase over the next 3 to 5 years. What we've also seen that as risk management tools, they're looking at climate much more than they used to. We have now 40% that already say we have risk assessment for climate, physical and transition risks in place. And then we have 45% of those surveyed said, well, we don't have it quite yet, but we are working on it and we will have it within the next 3 years. All to say that we don't see a downward trend yet. Maybe it's getting a little bit harder and really sort of the dust is settling, as I think Dimitrios really explained well. And the deep wiring is happening now. It's not anymore just sort of the quick and the flashy and the PR side. It's really getting into the weeds now, but it's not going away.
Yeah, of course. And that's, what matters, isn't it? It's like if firms are talking about it less, does that really matter? I mean, that representation is surely important, but as long as they're still doing the work, that's super encouraging. I guess one thing that we can't ignore, and I've seen we've already got a question on this subject, is the omnibus and this kind of slightly deregulatory agenda coming out of the EU. I saw a poll of business leaders last week, and it was like an overwhelming majority. I think it was about 85% said that they were getting ready for the CSRD. They don't want it to change again. What's your view on what's going on at the EU here? Because it, positioned itself as such a global leader in sustainability regulation, and now we're at risk of just kind of unwinding all of that work.
No, we're not. Rubbish. Absolute rubbish. I mean, look,
typical journalist.
Maya and I have been independently involved in some of this sort of stuff. Look, the Sustainable Finance Action Plan and things like the taxonomy that we've been involved in have been extraordinarily influential and get everyone thinking the same kind of way, common language, as banks in Europe regularly say. Been very powerful. But it's also a fair criticism that in the first wave of regulation we've put through, we've made some mistakes. We have. I've made many speeches about this, about the taxonomy being way too complicated, way too Eurocentric, and the cost of transaction too high. I had a bank the other day tell me that their green asset ratio, if you know the term, everyone, is 0.8%. It should be 18%. And that's because of the complexity of alignment with the specifics of the rules, which are way too complicated. This is not an uncommon problem with the first wave of regulation, especially in European countries. And now we have to necessarily go through as what the Commission is calling a simplification process. So in principle, it's absolutely important. It does not mean a weakening necessarily of, and there are fights to be had, of course, of ambition. Certainly in the eyes of the vice presidents, Teresa Ribeiro and Valdis Dombrovskis, it is absolutely not a weakening of ambition. They've been very committed from day one to everything from the Green Deal to the chat, and VNL, Ursula von der Leyen, is backing them on that. So far, so good. Of course, the detail can be difficult. Now, we're in the midst of some changes. A block of changes has been put through. Some more are coming. I'm watching for what I have seen as recommendations around simplifying adherence to do no civilian harm criteria to make it more practical. My own beef, which will make green bonds and taxonomy issuance easier. And I'm pretty certain that's going through at the moment, but I'm waiting to see the process. The CSRD, not all of that stuff's not over yet, is underway. I do appreciate for a lot of companies who've done all the work, this is a pain in the neck, right? Getting the regulation right is tricky. But on the other hand, against that is the potential for substantially easing the cost of transaction and moving from a compliance-driven transition to more of an opportunity-driven transition. The truth is, we don't fix climate change by telling everyone to cross the T's and dot the I's. We fix climate change by setting a direction, having industrial policy that encourages the right kind of investments going forward. So there's a necessary shift of emphasis now. We've done something successful, we have to improve on it, and we've got to pursue a more of an opportunity focus. So I think let's just see how the next few months pan out in terms of the detail. But we're a big supporter of simplification with ambition retained. And I think that's what we're getting.
Well, if I may add some thoughts on that, European banks are very heavily regulated. Regulation plays a very important role. It comes to scale up a lot of, let's say, voluntary initiatives that banks have taken over the last few years. Having said that, we know that if we treat regulation not only as a tick-the-box exercise, but as an opportunity to see where we have to drive our capital, where we have to support our clients, then regulation can be quite beneficial. In the case now of the omnibus, my personal opinion is that we reached a point where there was a lot of bureaucracy there, and maybe there was a lot more that was actually needed in order to be able to help the banks to make that transition to a greener, more greener economy. So simplification, I think, is very, very important. But we have to be very careful at the same time that we keep the ambition level that Sean mentioned, and we don't water down what we have been developing over the last few years. So simplification, we understand, but it has to help. And I just want to stress this thing. If the threshold drops behind, actually rises to about 1,000, employees per company, which will be required to, to report to CSRD or EU taxonomy, that will put an extra burden on banks to actually ask for more, actual data from the clients, because they won't be obliged to report, because they won't be in that perimeter. So these are the things that we have to really look into seriously, so that at the end of the day, this simplification will help competition, but at the same time will help banks access the information that they need so that they can report.
Yeah, fully agree with both interventions on this. I think for us, again, also, and maybe specifically because we work across different markets, not only, we work in some EU countries, but not only in EU countries. We also work with markets that are, however, economically very linked with the EU, and they want to export to the EU, they want to work with EU, they want finance flows to flow from the EU to them or from them to the EU. I welcome some simplifications. In particular, if you speak to a company in Morocco, for example, it's really difficult for them to comply, or if not impossible, for example, with the technical criteria that you can find in the taxonomy. So having some sort of simplifications there that don't remove the ambition but keep the whole thing usable, I think that's very much welcome for us, that we look across markets and not only at this with an EU lens. And then maybe not directly answer to your question, but for me related is, I think it's also super important that we not only focus on the reporting. The environmental social reporting is, of course, super important, but what's at least, if not more or equally, or if not more important, is the management, the target setting, the strategizing that we do before we even get to report. So for me, yeah, of course, we can discuss what's the right level of reporting, what's the right complexity, what's the right level of data. This is, of course, important. But for me, it's almost more important to really work with clients, with FIs, with banks, or with even corporates on really their internal strategies, their systems, their targets, what are they actually planning to do before we get to this end output of the reporting exercise. So we do this by working with clients on transition planning. We've seen also through our survey, by the way, we've made an interesting observation. We've seen that clients that have worked their way through actually designing and establishing a transition plan for themselves, they end up with way higher rates of integration of, for example, quantitative analysis for physical and transition climate risks. They've done all the work, and so they integrate this into their process. We've seen where, for example, clients get some sort of strategic plan or a transition plan imposed by the mothership, or then usually they don't really absorb it as much. And the rates that we've seen on them doing specific actions, for example, these analysis on physical risks or on transition risks, the rates are way, way lower. So I think it's important that clients look at the whole chain, not just sort of the reporting end, but really the whole chain from setting the strategy, setting the targets, doing all the management around both the opportunities and the risks, and then ultimately the reporting is an output of that.
Elizabeth, I'm going to comment that in a way we're seeing a bit of an unfortunate conflation in terms of commentary between the capricious infantile royalism that's underway in the US and the desire to make things easier for business to achieve the transition in Europe, which is they're very different things. They happen to be happening at the same time. People think, oh, it's obviously happening because of. No, not so simple. You know, there's been a push to, over the last couple of years in Europe, to focus on transition, to promote transition plans, but to also provide the enabling support, in some ways learn from the Chinese who've done this over the last 15 years, enabling support to make sure our industries can go green, whether that be ThyssenKrupp moving towards hydrogen or auto companies going electric and so on. And this is an extension of that, this whole omnibus. Simplifying things for industry is part of it. There's no diminution of ambition in Europe. Europe is simply very committed to it. I mean, hey, don't get me wrong, there are challenges, right? There's defense, there's energy security. Although even on that question, we've kind of learned in the last 3 months, well, we figured out we can't trust Russia, and suddenly we figured out we can't trust the US either. Yeah, what's the next step forward? We go to Qatar, and Netanyahu is pushing the US to bomb Iran. Bit tricky. There is a solution, and this is reinvigorating the renewable energy debate in Europe, which is we can grow renewables much faster if we sort out some grid problems. It's primarily a grid problem. So in a way, the European conversation is decoupled from the US conversation. In a way, it just looks like it's the same, and it's confusing. I fully understand that. But look at the detail and look at the actual practical changes, and look at the hard work that's going on to support transition in industry, in the property sector, and in banks. The work EBR doing. This report that Meager refers to is a fantastically interesting report. 99% of banks are telling us climate change is a real issue. This is a sea change from 6 years ago. Change is actually happening.
Yeah. It's interesting. So I have kind of taken the view that the EU, yes, of course, remains highly committed, but that possibly there is some connection with the US. I think maybe there's like concerns around competitiveness, and there has been a bit of pressure from US lawmakers. We don't know how a US-EU trade deal might end up treating some of the extraterritorial parts of the EU's sustainable finance agenda. Do you have a view on that?
Competitiveness, of course. I mean, if we're not thinking about competitiveness, we are mad. And let's face it, we have fluffed this in Europe over the last 10 years in lots of different areas. It's not the US, it's China that has become incredibly proficient in manufacturing. You know, I think it was Tim Cook who said from Apple that if you want to get a process engineer to work on Apple iPhone, you can find about 3 or 4 of them in the US. In China, you can find a football field of them. The education system is very directed. There's a whole bunch of things that China's done. Of course, that means we need to rethink the future of the European Union. in terms of competitiveness of other countries. We need to specifically move from being fixated on competing with China on manufacturing, commodity manufacturing, and that day's gone, right? We're moving to high-end specialist manufacturing. That's the Mittelstand. That's actually what they do. And moving to intangible industries. Most of the value in the S&P 500 in the US in the last 20 years has been created by about 7 companies, none of which own anything. No, Apple doesn't own anything, for example. Nvidia doesn't own anything. These are the lessons Europe's got to learn. So I think this competitiveness discussion, maybe it's triggered by the US, but really it's triggered by China, is absolutely essential for us. We need to get our act together. And the most important thing we need to do is to start thinking as Europe, not as a bunch of small principalities competing with each other in a small pot. We actually need to be one large entity competing with other large entities, being the US, China, and so on. So there are some, the Draghi report and all those sort of things. So there are clearly some things we've got to tackle, essential to tackle. And hey, if it takes a Trump to kick us into gear, so be it.
So it seems like we're going through a very important and very interesting period. All this, what is happening on the other side of the Atlantic, is actually pushing Europe to stand up, realize where it stands, and get its act together, in a few words, in becoming more competitive. But always bearing in mind, and I think this was mentioned in Draghi's report, that we always have to remember what brought Europe together, and that was that social structure. And we should become more competitive, but always build on the social way, the social structure that we have, the principles that we have developed over the last decade. So that's very, very important, because in the long run, that's what's going to make Europe more sustainable. We should not be short-sighted and just see what's happening right now, just because there's a specific, let's say, political situation in the world for the next 2, 3, 4 years. These issues are very long-term. Sustainability is a long-term, let's say, exercise. It's a big journey. So we could go through bumps, and not probably going through some bumps right now, but in the end, we have to look at where the lighthouse is showing us, where we have to go, and keep that and stay that course.
Yeah, it kind of reminds me of people talking about, when electricity was first invented, people didn't trust it and didn't want it in their house, and then everyone just gets on with it. Any new technology, it's going to go through this. Okay, I'm going to start moving to audience questions, because we have quite a lot to get through. The first one is slightly, I don't know, a bit tongue-in-cheek, perhaps. It's not aimed at anyone in particular. If investments in green assets are good for investors, then why have there been such massive outflows from them this year?
Well, in the bond space, in the bond space, which is the area I work in, that's absolutely not the case. I'm afraid the data is exactly the reverse. We continue to get significantly higher levels of oversubscription for green bonds and sustainable bonds than we do in ordinary bonds. So our biggest problem everywhere in the world, by the way, not just in Europe, is a lack of supply. So we need more green bonds into the market because demand is so strong. And there's a long story behind that. I won't go into it. In the equity space, I don't know. I mean, I'm not tracking that, but I'm going to say from bonds, which are the primary institutional investors, are clearly going in a certain direction, and that's going to have a flow-on effect to other markets over time, notwithstanding any jagged ups and downs within equity markets, and God knows we get jagged ups and downs in equity.
Yeah, anyone else want to add anything there?
Not really.
No? Fine. Okay, we have a few about the omnibus, which we have kind of touched upon. Sean, another one for you. The existence of greenium has showed that you cannot do both well and good.
What do you mean? The whole point of greenium is you can do well. No. This is a wrong framing. A wrong framing. We get a greenium at primary, and when bonds are issued, because where we have liquidity in green bonds, these things have proven to be higher value. So whenever there's a downturn of the market, when Donald Trump tweets something, for example, what you find happening is that green bonds hold their value. People sell off vanilla before there's ordinary bonds for they sell off green. And as a result, if you're a defensive fixed income investor, and remember that famous Larry Fink quote from BlackRock, he made his money not by giving investors yield, but by making sure they didn't lose their money. That's the nature of fixed income investors, they're defensive. And here we have, amongst green bonds, a particular instrument which is shown to be better at retaining value in the secondary market. Right? It's more valuable. As a result, those portfolio managers, whether they like green or not, are bidding tighter at primary. So when Dimitrios gets a client that issues a green bond in euros, they will more often than not get a greenium. But the split is different. So take when the Germans issued their green bond, their sovereign bond, the German bond traded at 5 basis points premium in the secondary market, and they got a 2 basis points greenium in primary, i.e. they split the difference. The investors grabbed half the value and the issuer got half. So this is a win-win product. It's unbelievably win-win. You are doing well by doing good. The investors getting some benefit, the issuer's getting better. I mean, why doesn't every single company in the world and bank of the world issue more green bonds? Is why, like, it's amazing.
Maybe just to add to that, we support many clients in often their first issuance of a green capital market instrument. And often what they say to us is, sure, question of greenium is one thing, but it also goes really beyond the financial, because for them, there's additional benefits. There's benefits of accessing a much wider pool of potential investors. There's benefits of having much clearer strategy where they want to direct those funds to. There's benefits sometimes, which is, I mean, not the most important point, but from perhaps, a reputational standpoint and so on. So I think it's a bit simplistic to value such issuances only on the tiny point of the pricing, ultimately.
Just to pick up, Maya's perfectly right, because while there is a greenium out there, every issuer we consult and research in our projects says to us, well, the greenium's nice, but actually we do it for, as Maya says, investor engagement. Deeper investment stickiness amongst investors is the term KFW used here. That's actually the primary benefit for most people. Greenium just gets rid of arguments in advance out of the way. That's why the German government and the French government finally said, okay, let's do it. But that's not why they keep doing it.
Okay. And I have one directed at Maya. So about the report's findings. So it says, how can we trust the findings of the report you refer to? Institutions can report, but there is no guarantee on their credibility. I think their concern is around greenwashing. And I would guess that one answer would be audit. But over to you.
I mean, look, this is a survey. This is not an audit exercise or, a regulated reporting exercise. So there was really nothing in it for the financial institutions to share their views with us. They could also answer anonymously if they wished to do so. So we take it for face value that what they tell us and is what best reflects their financial institutions' position. Now, they've also been quite clear on sort of the not so positive points. So I've highlighted maybe a few things that point us into like a very positive direction, but we've also asked them questions, for example, what limits you in doing green business? And we've gotten a lot of limiting factors that they've told us about. Interestingly, not so much related neither to reporting nor to legislation, but more to things like clients are not willing to adopt higher environmental social standards, or clients' awareness of sustainability is still very low, or green eligibility requirements, which is something that EBRD is very big on because we attach green eligibility requirements to all of our green instruments, obviously. They say that's super complex and, we don't like it particularly. So I think they've been quite honest in their answers. But look, what I believe, and this report is a snapshot. We wanted to gauge sentiment it is by no means an audit exercise or, a regulated exercise of reporting. So take it with that caveat.
Of course. Okay, and another question, not directed at anyone in particular. So we can debate whether or not current kind of changing sentiments are down to President Trump entirely or not. But the question is whether the Trump effect is going to be transitory or permanent.
That's not a very easy question, and definitely we're not prophets, that's for sure.
Crystal ball.
Basically, my angle to this will be, what I said earlier in this discussion, that the root causes are there. It's not because some political leader says that, climate change does not exist, or, we're not interested in social issues and whatever. The problems are there, and they're getting bigger and bigger and more intensive and more, how can I say, frequent. You can see what's happening in the States with the wildfires in California. We see what's happening in Greece, wildfires practically every summer, big floods. The issues are there, the climate issues, the loss of, let's say, nature, the pollution issues, the plastic issues are all there. And I think that, eventually we will be, I think that once we go through this obstacle, as I said before, there's bumps. The journey to sustainability is a very long journey. So, you're going to have some bumpy and turbulence on your way to reaching your goals. And I think that eventually, once we go through these turbulences, we're probably going to see an acceleration of all these issues, like investing in green, investing in renewable energy, investing in all these new forms in digitalization, and in all these, let's say, ways of investing that will try to mitigate, on one side, to mitigate the impacts of climate change, but on the other side, to adapt, because that's another issue that we have to look into. We're running out of time. We know that the impacts of climate change are going to be with us. Even if tomorrow we automatically push a button and we stop emitting, we will still be seeing the effects of the carbon emissions in the atmosphere for over 50 or 60 or 100 years. So in the meantime, we have to adapt. So there's a lot of work that we have to do. Mm-hmm. Agriculture, for example, we're seeing how agriculture is impacted. We see it in Greece. Greece is one of the, I think in a recent study somewhere, the 19th country in the world when it comes to water scarcity. These issues are real, and they touch the real economy, real people, and eventually they touch the real politics in the end, because they create all these social repercussions. So this is something that, we cannot avoid, and it's something that we have to face, either we like it or not.
I'm going to pick. Sorry, Maya, you go first.
Yeah, no, just very briefly, thanks. I just wanted to say, even if we take out all the, let's say, political discussion or geopolitical considerations out of this question, my view is that the transformation, the technology transformation of the energy sector, the technological transformation of our economic activities, that has started, and it's like a domino effect in my view. I don't think it's stoppable at this point. So I think that transformation is happening regardless. It could be a bit slower, it can be a bit quicker. You're surely all familiar with the theories of tipping points and whatnot. We don't know exactly how fast or when those will happen, but I'm fully convinced that the transformation of our economy for purely economic reasons, for starters, is happening and cannot be stopped anymore. So I think this will continue even only on that basis.
Maya's right. I don't think there'll be any fossil fuel electricity generation at all by 2050, and probably much earlier, because that's change is happening. It's becoming cheaper everywhere. Just one fact on that point, 50%, more than 50% of all Texas's energy comes from renewable energy generation. Texas, everyone, come on, get real. That game's over. But Dimitrios makes a really important point. about what's going on. Underpinning the Trump revolution and the revolution in other countries has been the rise of inequality, has been left out. We have failed to deliver just transition, not just in climate terms, but in terms of economic development over the last 20 years. The rise in inequality has been really severe. The left behind feeling by lots of people has underpinned Brexit, has underpinned the Trump vote, has underpinned right-wing moves in Europe of all kinds. You know, if we're in government or in finance, for that matter, and not dealing with addressing the challenges which could threaten the stability of our economies, we're going to create problems out of here. So this is a social resilience issue. The 21st century is a century of volatility. Climate change has seriously started. More people are going to die this year than ever before from heat in human history, ever before in human history. Just one fact point. We need to prepare to ensure resilience. And the first thing we have to address is to make sure that we are looking after our people, our brothers, our sisters, our kids, so they can survive this, not just those people in Gilded Towers, which we have doing. And if we don't address that just transition, we will see big revolutions, big rebellions, justifiable rebellions, but maybe ones that go off the planet. One good thing that Trump will leave us with is this sense that, you know what, we can change things in a really big kind of way. Now, I can't say I'm particularly happy with the lunacy that Washington, D.C., as I called it earlier, capricious infantile royalism. But one thing, the ability to be able to institute big change is refreshed, is reinvigorated.
Yeah.
Now we need to seize that moment and make sure that change really is for us all.
Yeah, I think that's a great note to end on. So we will call it there. Thank you so much to you all. That 40 minutes really flew by, and there's so many things we didn't get to talk about. I will now hand over to Professor Skiadopoulos. Thank you.
Thank you.
Goodbye.
Thank you, Elizabeth. Thank you, Sean. Thank you, Maya. Thank you, Dimitrios. Very stimulating panel and good food for thought.